Welcome to our Week 3 lecture. We will focus on how governments account for its expenditures. Our previous discussions focused on the recognition of revenues, which included both exchange and non-exchange transactions. This time we will cover exchange expenditures, since the majority of governmental fund expenditures are exchange transactions. Additionally, the non-exchange transactions are accounted for as a mirror image of the non-exchange revenues. Remember to review the learning objectives and outcomes covered in this week's readings. Let's begin. What are expenditures? Different from the definition of expenses, expenditures are decreases in net current financial resources. Expenses are decreases in net economic resource. Likely you recall this definition from previous financial classes. Imagine that your state or local government purchased equipment, and its funds are accounted for under the modified accrual basis. The initial recording of this transaction would report this as a capital outlay, which would be an expenditure recognized when the equipment was purchased. In contrast, if the accounting was based on the full accrual basis, the equipment cost would be reported as a capital asset and depreciated expense based on the life of the equipment. Expenditures are governmental fund equivalents of expenses. As you can see basically and very quickly, there are unique differences between how the accounting principles are applied in business and governmental funds. In governmental funds, net current financial resources are equal to short-term assets less short-term liabilities. So one may ask, what are financial resources? These are all assets, including cash, which can be converted into cash. Per GASB Statement Number 33, governments will recognize expenditures when it either pays cash for goods or services or a liability is accrued. Make sure you thoroughly understand when the government should recognize a liability. As a rule, under the modified basis of accounting, a state or local government should accrue a liability in the period that it becomes obligated for the liability. There are always exceptions to the rule. One exception permits government to postpone the recording of the fund and related expenditure until the time the liability must be paid. Notably, this allows a postponement of the eventual reduction in available and expendable financial resources. For a detailed discussion of all exceptions, go to GASB Interpretation Number 6. There is a unique situation which you may have a familiarity, wherein expenditures are not recorded in the financial statements of governments. It is often known as tax expenditures. As an illustration, if your city wants to attract a major company to its city, it grants the company a property tax abatement. It literally waives the company's property taxes for a period of time or maybe permanently. You would likely agree that the city has a cost in the form of lost taxes. However, the city neither records an expenditure nor a reduction of revenue. If you were an accountant, would you support a requirement that the city record the lost taxes as revenue and a corresponding expenditure? Just thoughts to ponder. As you think about this question, complete your readings on how the following expenditures and any related liabilities are accounted for in the governmental financial statements. expenditures range from wages and salaries to grants.